Hey everybody, I'm JC Peretz with AllStarCharts.com, and I am here with our Chief Option Strategist, Mr. Sean McLaughlin. Sean, thanks for being here.
Great to be here, man.
All right, so we talk to a lot of traders and a lot of investors all over the world, and one common question that I'm getting all the time is, when is it the right environment to just go out and buy a naked call or buy a naked put and just shut up and buy it? Or other times where it makes more sense to finance the trade by selling one or two other options and collecting that income to then go ahead and buy the call or the put. You want to talk a little bit about that?
Yeah, JC, you're getting to the heart of one of the core decisions I make right off the bat when I'm thinking about making a trade. One of the first things I look at is, where's the volatility? What is the pricing of the options in the stock? Because if volatility is high, I want to be a net seller of premium. Here's the thing about volatility. Volatility tends to mean revert. It doesn't mean it always mean reverts when you want it to, but on average, over time, if volatility is high, it tends to revert back to the mean. If volatility is low, it tends to revert back to the mean. So an edge that is irresponsible to ignore as an options trader is to always put yourself on the right side of mean reversion when it comes to volatility. So you mentioned being a long buyer of straight calls or straight puts. That's a typical newbie, rookie move. If they're bullish or bearish on a stock, they just want to go and buy a call or go and buy a put. Sometimes that works out, sometimes that works out great. But if they're not taking volatility into consideration, they're really putting themselves at a disadvantage. When I'm looking to be bullish, for example, I want to buy calls in a stock only if the volatility is low. And if so, that sets up what we like to call the all-star walk-off trade, right? Where it's a very low cost of participation, very low defined risk, but unlimited potential upside. We love those trades. Now on the flip side, if we're bearish, okay, and typically when we're bearish, volatility is rising because people are getting scared. Everyone gets scared when their stocks are going down.
They're buying insurance or whatever.
Right. Volatility, the pricing comes up, and a put that might have cost $1 in a quiet environment might all of a sudden cost $1.75. That's a huge jump in premium. So in those situations, I'm not looking to, if I'm bearish, I'm not looking to buy a put. I'm looking to maybe buy a put and then sell another put against it to finance the purchase of that put because it's too expensive. The edge is too far against me. I don't like that. I want to be on the side of knowing that if mean reversion happens, it's going to help. So, for example, if I'm buying that put when volatility is high, I'm buying the put because I want to have that directional bias in my trade overall. I mean, ultimately, I'm bearish, right? I want to have a directional bias, but I don't want to pay that price. I'm going to sell that out of the money put to finance that trade, and then if either the full move doesn't happen that I'm anticipating, or if the stock just kind of sits still, but if volatility comes in, well, that short put that I sold, I could buy it back a lot cheaper now, and I still have an opportunity to participate with gains on the bearish side.
Now let me ask you this: when you talk about how you're going to sell another put, right, or out of the money put, how do you decide whether you're going to sell an out of the money put or if you're going to sell a call against it? How do you make that determination?
Good question. Going back to the bearish example, if volatility is high and I don't want to just buy the straight put, yes, I could sell an out-of-the-money call. The problem with that, JC, is that is unlimited risk.
Yeah.
And as we both know, in bear markets, the bounces are vicious. And if I get short and all of a sudden this thing bounces and I'm short naked calls, I could have a pretty sleepless night.
What about from the long side? So what if you're trying to buy a call and you're trying to finance the call purchase?
So in that situation, that's a trade that I do like to take from time to time for one of two reasons. Either because volatility is high, so I'm uncomfortable paying the full price for that put or for that call, and I'll finance it by selling an expensive put because volatility is high. The other situation where I'll do that trade oftentimes is if it's a higher priced stock. Say it's like a $150 stock, a $200 stock, like a Boeing, right? What's it, $250? It's all over the place right now, but it's like $250. In that case, a slightly out of the money call in Boeing can be pretty expensive, and I just, maybe the volatility's right, but just the straight out of the pocket cost, the option might cost $20. That's expensive. Yeah. So I might be comfortable owning that stock if it got put to me. So I'll sell an out of the money put. Worst case scenario, stock tanks, I take possession of stock as part, but I'll only do that in stocks where I have pretty clearly defined levels where I know, like, if this level breaks, just close the trade out. Don't even argue with it. Yeah.
Yeah. Okay, so when you talk about volatility, Are you talking about volatility in the overall market or in the individual security?
I pay most attention to the individual security. I'm always aware of what the volatility is in the market because, you know, the market represents most stocks. But as you know, we're not afraid to go out to stocks that maybe are a little less covered, away from the fangs, right? I mean, wherever we see opportunity, we'll go after it. And so sometimes some stocks are in certain sectors where they're kind of marching to their own drum. Volatility might be low in the marketplace, but these particular stocks are high for whatever reason. So for me, it's stock specific all the time. I'm aware of what the market is doing, but that's not the core part of my decision. It's all about that stock.
You know, what I love about the options market is that we're not just trading price. It's not just a directional situation. Right. We're also trading volatility. So if you guys are interested in what we have to say, I encourage you to go to options.allstarcharts.com.